Hello and welcome to this Forex Preview at XM.com. The top tier of the Federal Reserve will head out to Wyoming for the annual Jackson Hole Symposium. Chairman Powell is scheduled to speak on Friday. In the past, this meeting has marked major policy shifts, so investors will be eyeing this event. I'm Maria Pachordes, and joining me to discuss this is Senior Investment Analyst Marios Hadjikyriacos. So Marios, it looks like Fed policymakers are in a tight bind, as their actions so far have not cooled inflation much, while other economic indicators point to a slowing economy. What signals could we get about monetary policy moving forward?
Hello, Maria. Well, I think we're going to get some major signals. So Jackson Hole is essentially seen as an unofficial Fed meeting, right? Because they have used it in the past to sort of signal big strategy shifts. Now, in a nutshell, I think that the Fed is going to try to nudge markets back into obedience. So, to explain, markets aren't really behaving like the Fed wants them to. So, for example, yields on government bonds are not high enough to slow an economy and fight, rampant inflation. Inflation is around 8.5%, but the yield on 10-year government bonds is around 3%. That's not really enough to truly slow the economy, which is what the Fed wants. Now, the reason this is happening is that bond traders are looking at the whole situation and they're saying, yeah, you know what, the Fed can raise interest rates all it wants this year, but we are still pretty confident that they will be cutting rates next year. And because this expectation has been embedded into asset prices, it's just making the Fed's job harder, right? The Fed might need to raise interest rates even more to compensate for the markets not believing that it will keep interest rates high. And that, of course, could put unnecessary pressure on the economy, and the economy is already losing steam, according to the latest business surveys that we've got. So it's a bad situation for the Fed, and ideally what the Fed wants is to raise longer-term yields without causing any real panic in the markets. So what are they likely to say? Well, one way to accomplish this would be just to stress that, look, we are going to raise interest rates and we are going to keep them high for as long as it takes to cool inflation. We are not going to be cutting rates at the first sign of trouble. That's one way of doing it. The other way would be through the balance sheet. What they could say is, yeah, we have this plan right now that we are going to reduce our balance sheet in a passive way. We are going to allow securities to just roll off of the balance sheet as they mature. But maybe, if the situation demands it, maybe we could examine the active sales of bonds. Maybe we could ramp up this process, and that would also be a pretty hawkish signal. I think that the first choice is much better. Just stressing the interest rates are going to stay high is probably what you want to do.
Okay, turning to the US dollar now. It continues to reign supreme against its major peers. Could the Jackson Hole Symposium add fuel to the rally?
I think so. So if the Fed is forceful enough, which I think they have to be, that could add fuel to the rally. But we also have to warn that, look at the chart of the dollar. It has already run so much, and the markets are already surely expecting a relatively forceful tone from Chairman Powell. Now look, the real point is the following. The outlook for the dollar is still positive, and it's hard to argue against the uptrend or to argue for a trend reversal while the outlook for the rest of the world is so gloomy. So in Europe, we've got an energy crisis that is going from bad to worse. That's almost going to ensure a brutal recession because heavy industry and the consumer are going to be affected. In Japan, we've got a central bank that doesn't even want to consider higher interest rates. The British pound is trading in lockstep with stock markets that are very volatile. And of course, we've got the implosion in China's property sector that is weighing on the commodity-linked currencies. So there is no alternative to the dollar. Even if the Fed slows down, there's just no real alternative to replace the dollar. And what might change this narrative? The only thing that I can see on the horizon can really change this story is a ceasefire in Ukraine. That war has been going on for 6 months now, and if we do get a ceasefire, that would be the first step for trend reversals in multiple charts. However, if you listen to the latest, if you read the latest reports around the war, it doesn't seem like a ceasefire is imminent. So I wouldn't be holding my breath.
Marios, thanks so much. And thanks for joining us at XM.com.